What does askance mean?
What? Askance? You've
Never,
never heard of the word askance?
never heard of this word.
Welcome to the continuing education of Steve Strazza. Hello, everybody. It's your boy Chicago Sean McLaughlin. I'm the chief option strategist at All Star Charts, joined by my friend, the head technical analyst at All Star Charts, Steve Strazza. Steve, what's happening?
It's going, man.
Hey, it feels like feels kind of weird right now, but you and I were talking this morning, and we were talking about some bullish setups. They feel very rare these days because there's a lot of busted charts out there. But you have found some. You detected maybe a change in the universe there from the other side of the world. Talk to me about the idea you're seeing today.
So I don't think there's any. I know there's not many. I don't think there's any besides the area about the group we're about to talk about. Any area of the stock market that's outperformed energy stocks over the trailing 3 months. It's been no small feat. But Chinese internet stocks, KWeb, are actually up like 50% from the
Chinese internet? Say what?
Yeah. So China, right? One of the culprits of this entire bear cycle, and then internet stocks, another culprit. Put them together, and you have near-term relative strength. I don't make the rules here. That's just what's going on. When we look at price, you could see it real well. The S&P is down 12% in that time. KWeb is up 47%. When we look at like just the weakest areas in general, a lot of them have been going sideways, building out nice constructed bases, whether it's biotech, IPO, ARC. But KWeb really stands out like in a league of its own when it comes to like this base building action, this bottoming action that we're seeing. And I think this quad pane chart shows that really well. So, if you want to talk to us about why you like KWeb, you look at it right here in the, lower left-hand pane. Nice little base there. We're back above 32, 33. I think you're going to get a nice little leg higher.
Yeah, I mean, that KWeb chart in particular, I mean, actually all four of these charts, they look like they just puked out in March, right? Total capitulation. We had a snapback rally for whatever reason. Doesn't matter the reason. Who cares? We faded it a little bit, but we found support above the previous lows. And I mean, it's the range is tightening. The fear seems to be abating. Seems like risk is being put back on the table here. I mean, if you're looking for a long-term, maybe long-term's not the right word, but if you're looking for a bottom of sorts, you have to like the trading action that we're seeing here.
And you talk about what happened in March. You could see it on this chart right here. This was a bullish momentum thrust. This ETF went from about 21 to 30 in one day. It was up about 40, 50%. So we have the bullish momentum thrust in place. Like you said, we kept basing out a little bit, but made higher low in all these areas, which you really can't say about most things right now, making a higher low in April, May, like you got here. And now we're back at multi-month highs.
Right. Now, call me old-fashioned, Strazza, but the idea of investing, whether in stock or options, of individual Chinese stock names makes me a little uncomfortable. It's not something I like to do for a variety of reasons. But this ticker KWeb, this is an ETF, right? This tracks a broad basket of Chinese internet stocks. So I feel like it mitigates our risk a little bit, correct?
I agree more with where your head's at on that. Because
yeah. So if we like the space,
yeah.
Sorry, didn't mean to cut you off. Go ahead.
Even the most quality stocks in China, something like Alibaba, I mean, these things have been killed, like 80% drawdown. So I agree. Spread that risk.
Right. So this chart you got up here, I used in the blog post today because I love this chart. First of all, I love what we're seeing in KWeb we broke above that long-term downtrend line, and we've been, more or less consolidating above that line. But then when you add in what looks like a potential imminent breakout in relative strength on that bottom pane, that really was the icing on the cake for me. That's what really got me interested in putting a trade on here. And I like that, it can have a nice little bounce. Kind of similar to that Zoom trade that we put on a couple weeks ago. It's like it's come down from such high levels that this thing could bounce for a little while and still, still not even retrace 50% of where it was.
Right. So with that in mind, I mean, like I said, we break out of this little coil like you're talking about right here. Seems like we got that trend line break, and now you could call this a pennant, call it a little bull flag, right? So we're betting on an upside resolution from here. And that probably, gives us a nice little reaction higher. So what are you thinking from option strategy perspective?
So when I started crafting an options trade, the first thing I looked at, which is the first thing I always look at, is where is the implied volatility? I don't have a graph for it here, but implied volatility is a little bit high. It's not insanely high, but it's not cheap. And so I wanted to employ a spread, and Strazza's got the chart up here now of the position we put on. We put on a November bull call spread. I did this for two reasons. Number one, because of the high elevated implied volatility, meaning the options prices are a little bit higher than I'd like to pay. By using a spread that minimizes any effect that any shrinking of volatility might have. If the stock were to go up, it's likely that vol will come down a little bit. Using the spread, it neutralizes the negative effect of the contraction of the implied volatility. That's the reason number one why I chose a spread. Reason number two I chose a spread is that it defines my risk. Okay, I've got a trade on here that if the bottom falls out in China for who knows, any headline out there, right? You could pick them: economy, virus, war, whatever, right? Anything could happen. And if the bottom falls out, at least I will know that my risk is defined here. The absolute most I could lose in this trade, in this particular trade, as you can see in the chart, is $2.50. So what I did was I went out to November, gave us some time for this thesis to play out, and I purchased a 35 call and I shorted a 45 call, creating the bull call spread. The net cost on that was $2.50. So that's, again, the most I could lose. Now, the most I can make, the most the spread could be worth is $10, right? Because it's the distance between the spreads. The difference between the 35 call and the 45 call is $10. You subtract the $2.50 that we paid for it. Therefore, the most we could possibly make is $7.50. Now, I'm not holding out for a $7.50 gain, Strazza. It's not something I do. I don't hold these positions till all the way to expiration if I can help it. I like to get out when I've captured half of the maximum potential gain there, because, we can't make any more than $7.50. So, excuse me. Once I'm up about half of that $7.50, so let's call it $3.75, that's when I'll look to exit the spread for a profit. So if you work that out, that would be, I have a resting order to sell this spread right now at $6.25. That would give me my 50% profit, or 50% of max profit, without having to hold the spread all the way to November. Look, if it goes there tomorrow, great. I'll take the profit and go, right? I don't think it's going to get there tomorrow. Might not even get there next week, but I like my odds.
Like I said, back in March, this ETF made a 40% move in a single day. So,
yeah. And one thing we didn't highlight, if you bring that chart back up, there you go. It's maybe hard to look in that zone there, but we've got a pretty good risk management level to lean on, which is the 28 level. It's actually below. Yeah, it's kind of below. You're right there. Yeah, below those lows. 28 level, there's a couple things working for it. Obviously, it's shown that was a pretty significant level of support by the price action. But also, if you had a 50-day moving average on that chart, you would see the 50-day moving average is basically right at 28 right now. So those two things, to me, give me a little credence to say, all right, 28 is a pretty significant level. If we break 28, that's my signal to get out. I will close the trade to salvage whatever premium is left in it. Hopefully it'll be enough, because we have till November. So that's my risk management level, Strazza. 28. Any close below 28, I'm getting out the next day.
So I like that for a number of technical reasons that you didn't even mention. Yes, if we're back below 28, it means we no longer are above that downtrend line, right? So we're giving that back. And then also, if we were to really zoom in on this chart, we could draw a little bull flag here. If we're below 28, that means that bull flag, which should be resolving higher, is failing and resolving lower. So we wouldn't want to be in it at that point.
Well, if you do make that chart for another blog post and you do make a bull flag, could you make it in the Chinese flag? Just come on, put a little Chinese logo there or whatever. Use your creative muscles there, Strazza. All right. To sum up, that's our trade this week. That's our free trade of the week. We are buying the November bull call spread in K-Web. We're buying the 35 calls, selling the 45 calls. A net cost, we paid $250. You might be able to get a little cheaper right now, but that's our bet. We got, 4 months, 5 months for this to play out. We like our odds, and we like the fact that we have a good, legitimate stop loss level that's nearby at 28 that tells us that we're wrong. Strazza, thanks for the great idea on this. I give you all the credit. You put this one on my radar, so thank you. Great job.
This is fun. Catch you next week.